Josh, we're closing in on the end of 2025, and we've had a lot of different client interactions and conversations throughout the year. One of the questions I get a lot is, what do you expect for 2026? I always find that, looking forward is more difficult than looking backwards and trying to reflect on what happened and what we can learn from that. Is there anything in particular from last year that you're trying to take away and apply forward?
Yeah, I think coming into 2025, one of the concerns was valuation and what earnings were going to look like. We had a new administration. It turns out that earnings have surprised to the upsides. We've had a lot of momentum in earnings growth. And unlike 2023 and 2024, when the market rose, but it was primarily from valuation, in 2025, we actually got earnings growth that drove the majority of the gains. That earnings momentum in the technology space is somewhat surprising because technology was the leading sector so far this year in terms of return, but the earnings for technology grew faster than the returns. So technology is actually cheaper today than it was a year ago. And obviously everybody's heard of the Mag 7. Those companies are growing much faster than the overall market, and their valuations are actually pretty reasonable when you consider the growth outlook.
Right.
And then you've got a subset of stocks underneath, like a Palantir or a CoreWeave, where they're trading at excessive valuations that are building in growth out 5 and 6 years from now that might be hard to achieve. And so you really have to look underneath the hood at what you want to own in technology, be diversified, and kind of stick to quality and companies that have more cash flows.
Yeah.
And I think that's probably the setup for 2026, given where valuations are. Expectations are for earnings growth to be low double digits. And so we could see a similar kind of setup, and maybe we even see valuations come back in a little bit and we get kind of a high single digit return. I think that would be a reasonable setup.
Yeah. I think the diversification point is a good one because it's easy to look at the names in your portfolio and get comfortable with owning the Mag 7, the Googles, the Amazons, because we're comfortable with those businesses as a whole, right? But we've got to remember, if you go back just to 2022, a lot of those stocks got cut in half that year, and nothing really changed. Their earnings didn't decline. It was just that particular time in the market, from a valuation standpoint, they underperformed, and they underperformed significantly. And as we know, if you have a stock that falls 50% in value, it has to make up 100% just to get back to even. And so they're still great companies, and we own them, but we do want to be very mindful of what degree we own those stocks. One of the things that's been interesting to me is, despite what happened in the end of the first quarter this past year, it's been a really low volatility type of year, right? We haven't had, really many market moves outside of a 1% swing, aside from the tariff sell-off in the first quarter. And so one of my expectations is, I think volatility is likely to probably come back in 2026. I mean, we're starting from a point where higher valuations in the equity markets mean that stocks are priced for perfection. And so any hiccup in earnings, any guidance misses, we could see some pretty big swings. And so when we talk about potential volatility with clients, I think the natural inclination is for clients to say, well, what do we do? How do we avoid it? And in reality, there's not a lot that you want to do because you can't time the market. And we've experienced that in the past. And so one of the things that I've been excited about that we've been incorporating is the use of ETFs, because you get the benefit of the rebalancing inside of the ETF without the concern of the tax side of things. And I'm curious, from your perspective as a portfolio manager in your prior life, where there was the consideration of tax implications when you were choosing to sell a stock, how do you think clients should be thinking about utilizing ETFs?
Yeah, so I think when it comes to looking for tax efficient vehicles to implement strategies, I think looking for areas like dividend growth and for quality, which have stood the test of time. We've got data going back decades that show that you typically, if you follow those thematics, you get above average returns with below average risk. And so we've been looking for exchange traded funds that follow those thematics.
One thing that interests me is how much the market has changed over the years from how you can invest, the different structures that are out there, and I think most investors are more comfortable picking an individual stock that they know, right? They shop at the store, they wear the goods, but for us, we tend to look at other dynamics, right? And one of the things that we look at are factors, and we utilize ETFs to incorporate that. And factors can obviously mean a lot of different things, but can you try to distill one or two factors that we think are
Sure.
of interest?
Yeah, I think to your point, the vehicles that we use to invest may have changed, but these factors have stood the test of time. And so a factor can be anything as simple as a price to earnings ratio. So it's the price that a company trades at divided by the earnings that they generate. That's a basic valuation.
And that's arguably probably the most commonly known factor that's been out there for a long time.
Correct.
PE multiple, right?
Right.
Okay.
Yeah. So quality is another term that we've used a few times. And so quality is synonymous with return on equity. So it's the profits that a company generates divided by their book value. So essentially, the more profits you generate from the asset base you have, the higher quality you are. Mm-hmm. And over time, those companies have outperformed. Similarly, we look for free cash flow, right? So the profits that a company generates divided by their market value, right? Those companies have historically outperformed and had less downside risk.
Right.
Dividend growth. There's dividend yield and there's dividend growth, and so we have tilted towards dividend growth, in part because when a company has a really high dividend yield, it can sometimes be a red flag, right, that they're not earning the dividend or they're not growing or they might be ready to cut the dividend. Right. Companies that can grow their dividends typically have businesses that are growing a little bit more. They have potentially more coverage of that dividend, and so we like the companies that can grow them over time.
I think at the end of the day, we're looking for companies that are in a position of strength, right? And with free cash flow, these companies have the ability, with discretion, to spend their dollars. They're not anchored to paying out a high dividend, and then they can't reinvest back in the business or do stock buybacks. And so, is it fair to say that with free cash flow, it's a company that's able to execute at their own choosing? They're not over levered. They're not paying out high debt. They can choose how to spend every dollar that comes in. So if you think about it at the household level, right, you're not living paycheck to paycheck. You're able to sort of build up those cash reserves and save and invest for the future.
For sure. And I think that's, getting back to the Mag 7, that's one of the things that we like about these companies. We've got this AI boom and they're spending all this money on CapEx, right, to grow their AI infrastructures. But because they generate free cash flow, so far they've really been spending that out of the free cash flow and haven't had to go borrow the money to do it.
Which is a big difference from the tech bubble where most of the growth then was coming from debt, right?
Correct.
We've spent some time going over our view of the markets, but beyond that, as we head into a fresh year, I think it's important for investors to take the time to try to get organized and have a plan. As we expect more potential volatility this year, I think having a plan really helps get through that. So, it's something that as we've grown as a team, we've incorporated and certainly tried to extend that to all of our clients. If it's something that we haven't done for you yet, we encourage you to call us and let us know. We think it's immensely valuable, especially when market volatility picks up. Having a financial plan in place, gives you an anchor to look beyond what's happening just that day, that week, or that month. So I do think planning is something that is a good initiative for you to take on if you haven't yet.